Trade with clarity.
All right, let's talk about the history of technical analysis. Now, if you think chart patterns are some new thing that popped up with the internet, well, you're in for a pretty big surprise. We're going to wind the clock back, way back, over 300 years to find out where the charts we all use every single day actually came from. Let's dive in. Seriously, just let that sink in for a second. The exact same candlestick patterns that traders obsess over on their screens today, they were being sketched out to trade markets before the United States was even a country. This game is old, and you know what? The principles are absolutely timeless. So where does this whole story even begin? Well, for that, we have to travel all the way back to 18th century Japan, to a really bustling rice exchange that, believe it or not, laid the groundwork for literally everything that came after. Our story starts with this man right here, Munehisa Homa. Now, he wasn't some Wall Street whiz kid with a fancy degree. Nope, he was a rice merchant, but he was also an incredibly sharp observer of markets, and more importantly, of people. And he came up with this revolutionary way to visualize the market, a tool that would outlive him by centuries. Here's where Homa was an absolute genius. He figured out that to really understand the market, you couldn't just look at the numbers. You had to track the emotions that were driving those numbers. So his candlesticks, they weren't just data points. No, they were little pictures of the collective fear and greed of everyone in the market. And this just nails the core idea, doesn't it? I mean, the stage has changed completely. We went from physical rice exchanges to these global decentralized digital networks. But the engine driving it all? It hasn't changed one bit. The market's operating system is, and always has been, plain old human psychology. Okay, so let's jump to the next chapter in this story. We're going to fast forward now to the late 1800s in New York City, where another pioneer started to put a formal language to all these market movements. So meet Charles Dow. And what's really interesting is that he wasn't a trader. He was a journalist. His entire job was to look at the absolute chaos of the market and somehow make sense of it for the average person. And through his work at the Wall Street Journal, he began to notice these repeatable behaviors and started building a framework to find a little bit of order in all that noise. And here's what he came up with: Dow theory. This is the bedrock of pretty much all modern trend analysis. See, Dow wasn't just drawing random lines. He was putting names to things he could see happening over and over again. He saw that markets move in clear trends, that those trends have phases like accumulation or distribution. And this was key. He realized volume was the secret sauce that confirmed the strength of a move. These ideas are just as powerful today as they were over 100 years ago. So Dow basically set the stage, right? And then in the early 20th century, a whole new generation of brilliant analysts came in and started building on top of his foundation. You could really call them the original quants, just sitting there reading the ticker tape, trying to decode what the market was thinking. First up, you've got Richard Wyckoff. He took Dow's ideas about volume and just went way deeper. He had this idea of a single huge entity. He called it the composite operator, basically the smart money, and he figured out how to spot their footprints in the relationship between price and volume. He was looking for those clues of accumulation before a big run-up, or distribution before a sell-off. Then you have W.D. Gann, who is a much more, well, mystical character. He was blending geometry, astrology, and old-school math. He truly believed that the markets were governed by these natural laws, and you could predict them using very specific angles and time cycles. A unique approach for sure. And rounding out our trio is Ralph Nelson Elliott. This guy retires, and what does he do? He decides to study 75 years of stock market data for fun, and he finds something amazing, that all the chaotic squiggles on a chart were actually made of repeating fractal patterns that he called waves, and he realized they were driven by the natural ebb and flow of human psychology. So even though their methods were all over the place, from volume analysis to astrology, they were all trying to solve the same exact puzzle. They all operated on this core belief: if human nature repeats itself, then the patterns it creates in the market must also repeat. And if they repeat, well, then maybe, just maybe, they can be predicted. So you've got all these incredible pioneers with these powerful concepts, but the knowledge was still kind of scattered, you know? All that changed after the war when a couple of guys decided to sit down and write the definitive rulebook for an entire generation of traders. In this book, wow, this was a complete game changer. It came out in 1948. It's called Technical Analysis of Stock Trends, and it took all these amazing but complex ideas from Dow, from Wyckoff, and others, and it just organized them into a super clear, systematic way to read charts. I mean, the staying power of this book is just staggering. The exact same patterns they laid out in this book back in the 1940s are the traders are hunting for on their screens at this very moment. It doesn't matter if it's a forex trader on a 1-minute chart or a stock investor on a weekly chart. It's the same stuff. And yeah, these should all look pretty familiar. You've got your head and shoulders top, ascending triangles, flags, double bottoms. Edwards and McGee gave these patterns their names. They defined the rules for how to trade them, and in doing so, they created this universal language for chartists all over the world. Now, for decades, charting was this painful manual process. You had to have graph paper and a pencil. But then came a technological revolution that took technical analysis from this kind of niche skill and turned it into a global phenomenon. First, computers hit the scene and made complex math instant, which led to this huge explosion of indicators. Then, the internet and cheap charting software yanked TA out of the big institutions and put it into the hands of pretty much anybody with a computer at home. And now you've got crypto and social media, which have basically made reading charts a mainstream activity. So this tech boom gave us thousands of new indicators, right? RSI, MACD, Bollinger Bands, you name it. But it is so important to remember this one thing. None of them, not a single one, gives you new information. They are all just fancy math equations based on price and volume. They're just a different lens to look at the same core data. And this has created a really fascinating situation in the market today. On one side, you've got these high-frequency trading firms using super complex algorithms to trade these same patterns at the speed of light. And on the other hand, you have this growing movement of serious retail traders who are stripping all the indicators off their charts and going right back to the basics, the stuff that Homa, Dow, and Wyckoff are looking at: pure price action, market structure, and context. So here we are after a 300-year journey from Japanese rice markets to global crypto exchanges. The tools we use have completely transformed, but the underlying patterns of human fear and greed etched into our charts, they have stayed remarkably, almost spookily the same. The history is written. The only real question left is the one that every single trader has to ask themselves when they open up a chart. What are these patterns telling you right now? What is your favorite chart pattern to trade? Comment it down below. If you want to know more about technical analysis and chart patterns, click that subscribe button. Thanks. See you in the next video.